Hey, Dan Passarelli here. How are you feeling today? Let's see here. Today we're going to be talking about understanding the Greeks again. This is Greeks month. Yeah, man. Greeks month. Today we're going to specifically focus on theta and the role of time decay. Now, I want to make sure that you can hear me. If you can hear me, please go to the questions box and give me a big woo-hoo. Let's do it. Can you hear me? Woo-hoo. Yeah, yeah, yeah. All right. Jeez. Junior, you don't know how to spell woo-hoo. Jeez Louise, what is going on over here? Oh my gosh. Justin woo-hoo. Shane woo-hoo-hoo. Uh, let's see here. Dan, yeah, yeah, yeah. I like it. I like it. I like it. Okay, I presume everyone else can hear me. Maybe you're just not as excited, don't have that energy that some of the other folks have. I mean, there we go. All right, thank you, Anonymous. That's right. Keep your information safe. Don't let anybody steal it. Yeah. All right. Before we get started, yeah, Sheldon. All right. Before we get started, I need to point out options are not for everyone. Please read characteristics and risks of standardized options before trading. Get a copy of that by emailing investorservices@theocc.com. Get a copy of that by emailing investorservices@theocc. Don't trade with money you're not prepared to lose. Don't trade with money you're not prepared to lose. And what we're doing here is giving generalized information, not necessarily specific to your situation. I don't know your situation. I'd like to get to know you better, but we're not there yet. But if you keep showing up on Tuesdays, I'll get to know you better. Now, for those of you who this is your first time showing up on a Tuesday, first of all, my question is, what the heck you been doing with your Tuesdays? You got something more important to do on Tuesdays than get your options training in and move your skills forward and get better at your craft, be able to be smarter, more consistent, more profitable? What are you doing with your life? I want to see you here every Tuesday. So, if this is your first time, allow me to introduce myself. My name is Dan Passarelli. Been in options for a long, long time. I am an author of two of the most popular option trading books. The one I'm most known for is Trading Option Greeks. That's been rated as one of the top 5 options trading books. And if you are interested in the Greeks, go ahead, pick it up. In addition to being an author, I am a trader, been trading since I was born. Not really, but since I was in college, I actually at least traded around in mutual funds and stuff. So I've been in this business for a long, long time, over 30 years. I'm the founder and president of Market Taker Mentoring, which is the leader in option trader education globally. We have students in over 50 countries. You believe that? We've put tens of thousands of people through our classes. And I am a collaborator in the trading industry. I work with some of the best organizations in options, including, and today especially, Firstrade. Work with Firstrade and other option-friendly brokers and most of the options exchanges literally in the world, not just the US, but in the world. And I'm a family man, married to my wife, Kathleen, who, if you are a Market Taker student, she runs operations here, and you probably interacted with her, and my 2 adult children. And I do other things for fun besides trading. I'm a runner, foodie, love to eat. That's why I have to run. And traveler. Me and my family been all over the world together, traveled quite a bit for Market Taker as well. I'm a music person. I enjoy music, listening to it, playing it, the whole shebang. And again, for those of you who are really interested in the Greeks, this is my book, Trading Option Greeks, which is available anywhere. Amazon is probably the cheapest place to get it. But if you just want to dip your toe in the water, I will give you this for free. This is my quick reference guide for the option Greeks. And you can get the quick reference guide by going to markettaker.com/QRG. That stands for quick reference guide. markettaker.com/QRG. And go ahead and grab that today. So let's talk about exploiting theta. Okay. We've got a lot to talk about. Let's just jump in here. Time decay and theta. So you probably have noticed this, even if you're brand new to options, if you've ever just even looked at them, you probably have seen, hey, you know, there's a stock at 40. The options that expire in 3 months are worth $2. The options in a shorter expiration, 2-month expiration, are worth what? Something less, right? The ones in a 1-month expiration are worth something less, right? The weekly ones are worth something less. If you had to guess, what do you think if the 3-month option is worth 2, what do you think the 2-month option would be worth? How about the $1.65? The 1-month option maybe about 110. And I put this in here because if you'll notice, as 1 month passes, this goes from 2 to $1.65, 35 cents less. As another month passes, it goes from 165 to 110, 55 cents less. What's going on here? Well, let's take a look. First of all, there's a phenomenon called time decay. And that is the observation that option prices decrease as time passes. And this is known as time decay or simply erosion. Now, time decay hurts long options. If you buy an option because it gets worth less over time, isolating just the time passing influence, that hurts you. Now, we talked about delta last week. So you might make money on delta. You might lose money on delta, but you are definitely losing money as time passes from decay. And this is why options shorting strategies are so popular, income strategies. If you're short options, time decay actually helps you because you're short it, you want it to get worth less. Now, delta might help you, delta might hurt you, but time decay will always help you. Now, also, only extrinsic value or time value decays. So let's take a look here at the Firstrade platform. Took a couple screenshots a little earlier. And as you know, on the Firstrade platform, well, you might know. Here, I'll just show you this really quick. This is where I got these screenshots from. You can pull this up and you can look and get all this information, the last price, the change, bid ask size, which is nice, volume and open interest. But what if I want to see the Greeks? No problem. Just come over here, go to Greeks Analytical, and we'll just look at the same time frame. What was that? This one, I think? Yeah. No, it's this one. Right? I don't know which one it was. I think it was this one. But anyway, you can get the implied volatility, which we'll talk about next week, the delta, which we talked about last week, gamma, which we talked about last week, rho. We're not really going to talk about rho this month, but and get your theta and vega as well. So what I did is I just simply took a screenshot of where the price is, took a screenshot of this one with the bid ask, took a screenshot of this one with the Greeks. And let's look at the 558 puts. So if spiders are at 558 and 75 cents, we're going to have a little contest here. This is for a brand new car. No, I'm just kidding. This is for the pride of being the one to answer this first. Are you ready? Wait a minute. I got to see if our ringers are here today. Hold on a second. Who's in class here today? We got Adam and Alex and Ashley. Oh, I'm going in alphabetical order. Somebody here is one of our ringers. Starts with an A for the first name here. Okay. Well, we'll see. I'm going to tell you right now, you've got some stiff competition. I'm not going to lie to you. So if you want to be first, you got to be, quick on the draw. There's the quick and the dead, right? Okay. If spiders are at 558.75, are the 558 puts in or out of the money? What say you? I need sound effects, like a whistle. Steven says in. Oslam says out. Jeff says in. Holy cow. Anybody else? No? All right. Well, I'm going to tell you something. It's always a little trickier with puts. Hopefully you heard me say puts. It's always a little trickier with puts. Here, if I can sell spiders at 558.75, I wouldn't exercise my right to sell them 75 cents lower at 558, would I? So those are actually out of the money. Our ringer, Oslam, gets it. Boom, 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 boom. Nice work. Okay, so that's right. They are out of the money in this case. And anybody who said in, don't worry. Puts are tricky when you think about it. And usually people, like in my position, use calls and examples instead of puts. So I made it a little extra tricky. So don't beat yourself up about that. Okay, so these puts are out of the money. Yeah? So what does that mean? Well, I said before, only extrinsic value or time value decays. So if these are out of the money, if I buy these at 940 and they remain out of the money all the way through expiration 8 days from now, the entire thing will decay. It'll go to zero. I'll lose everything I paid for it. Of course, if I sold them, that would be good, right? I want them to go to zero if I sold them. And Oslam points out too, an easy way to tell what's in or out of the money is Firstrade shades in a sandstone color. The in the monies and the out of the monies are in a white shade. Makes it nice and easy for you. Okay, so, the entire value decays if they remain out of the money. If they don't remain out of the money, that changes. We'll look at that in a second. So, okay, if there's 8 days until expiration, I'm going to show you a trick, okay? Here's what I like to do. You know what my objective is for doing these trainings here with you every Tuesday? It is to make this the best class that I possibly can. Why? To make you the best trader that I possibly can. I put effort into it. I try, right? You should always put effort into anything you do in life, right? I think so. So I'm not just going to show you how theta works. We're going to take it a step further. I'm going to go a little deeper here for a second. Going off script. So if the puts are worth, and let's just call it 940 for now, and there's 8 days until expiration, how much would I lose per day if I bought them at 940? Now, a very logical approach to this is to say, well, grab my calculator that I bought in about 1993, and it still works. A testament to Texas Instrument Products. I'm not a doctor. I just play one on TV. I'm not promoting necessarily Texas Instruments. Well, I am promoting it. I bought this calculator literally in frickin' 1993, and the thing still works. You believe it? They don't pay me for this, right? So, yeah, Jeff, nice work, but hang tight. You would think, like, okay, if I pay $9.40 for it, it's out of the money, it's going to decay. In 8 days, it's going to be worth zero. Well, I should just take $9.40 divided by 8, right? $1.17 and a half. That should be how much it loses value every day, right? Wrong. Wrong. So there's a little bit of a nuance here. And we're going to reinforce it later, but I'm going to tell you about it right now. At the money, near the money options, lose value at a, thank you, Stephen, exponential rate, at an exponential rate. So they start out losing their value very slowly. Today, these puts will lose, and now I'm down here, these puts will lose 60 cents in value today. But as time passes, their theta gets bigger. They lose more each day as time passes. So tomorrow might lose something like 65 cents. The next day, maybe 90 cents. The next day, maybe $1. Okay. Now, another little nuance here. Let's look at the 558 calls. Oh, here, hold on a second. I want to make this a little less confusing here. Let's look at the 558 calls. Okay, another question for you. Let's see who's first on this one. I got to get my sound effects here. If the spiders are at 558.75, the 558 puts are out of the money. Are the 558 calls in or out of the money? 1, 2, 3, go. This is for the pride. The pride. In. Sheldon is first. Boom. Stephen, you're a close second. Peter, you're a distant third. Got to be quick on the draw. Unless, if you're watching on YouTube, I think there's a delay, so maybe you were first, but I don't know. Okay, so anyway, yes, they're in the money. So remember, only extrinsic value or time value decays. So what part of this will decay and what part of this will not decay? Well, if we take the stock price or the ETF price, 558.75, minus the call strike, 558, that's 75 cents of intrinsic value or in the money value, and that does not decay. So if I were to buy these calls at $9.97, $9.22 would decay. If spiders are exactly here at expiration, they'd still be worth the intrinsic value of 75 cents. And so the theta here is 66 cents. All right. All right. Now, hold on a second. Now, another question that I have for you here is, I'm talking about this like, okay, what if I buy these? What if I sell these? If I buy them, I'd be buying them at $9.97. If I sell them, I'd be selling them at $9.96. The puts, if I buy them buy them at 940, sell them at 935, which price am I supposed to be using? And which price is the theta calculated at? Because, I mean, especially for the puts, if I buy them at 940, the total decay, if they stay out of the money, is 940. If I sell them at 935, the total decay, if they stay out of the money, is 935. So the theta, it must matter if I use the bid or the ask, right? Did you ever think about that? I bet a lot of you never thought about that. Well, the theta is actually based on, well, it's actually based on the theoretical value. It's based on a value that typically sits between the bid and the ask. The way this works is, well, my career before helping individuals obtain financial freedom through option trading was to be a market maker on the trading floor. So I used to be one of those guys in the crazy jackets on the trading floor. What I would do is I would run a theoretical value for every single option that I traded. And I would consider that what the option is worth. And then I would buy below it and I would sell above it. I would set my bid below it. I would set my ask above it. The theta was based off that theoretical value that ran through the middle. And so then I would look at it as, well, if I sold it above my theoretical, I'm making theoretical 2 cents or whatever. I bought below my theoretical, I'm making theoretical 2 or 3 cents or whatever. Okay. Now you'll also notice that the call theta is 66 cents. The put theta is 60 cents. Well, why is that? Why are they, should they be the same? I mean, why are they similar and why are they different? Well, they should be similar because of something called synthetic relationships, where if I were to buy a call and, well, if I were to buy a put, that would be this. Well, okay, no. If I were to buy, you can look at it either way. If I were to buy a put, that would be the same as buying a call and shorting stock. So they're similar, but the only difference is there's an interest rate component, and that's what makes the thetas a little bit different. All right, so let's blow through some rules of thumb here. Near the money options have less initial time decay and more as expiration approaches. And I just showed you how that would work if it was straight line theta versus actual theta. In the money and out of the money options, they have a more linear rate of time decay. So it kind of looks like this. When there's 8 weeks until expiration, they lose just a little bit between week 8 and 7. Lose a little bit more between 7 and 6, 6 and 5. A little bit more between 5 and 4, 4 and 3, 3 and 2, 2 and 1. And the last week is where the most time decay happens. And so if we were to look, this column here would be theta. The column all the way to the right would be theta. So we would just see it growing and growing and growing as time passes. So I'm throwing around this word theta. What exactly does that mean? Theta is the rate of change of an option's value given a change in the time to expiration. So theta values, so okay, and so that's stated in like dollars and cents. You saw that the theta for that call was 0.60 blah, 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 or 0.66 blah, 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 right? Just rounding, it's 66 cents of option premium. Theta values are usually based on a 7-day week, which is kind of weird since we only trade options 5 days a week usually, right? Sometimes 4 if there's a holiday. So Why are they based on a 7-day week? Because this is a valuation model. We call it an options pricing model, but it's really an options valuation model. And options can change value over the weekend. If over the weekend, for those of you who are watching this live, there's been a lot of volatility because there's been a lot of new unexpected news coming out. If very unexpected news, especially something major, is announced on a Saturday or a Sunday, that could cause the futures, or even if it's Saturday and the futures aren't trading, that would cause the value that individuals will think a given stock should be worth to change. Even if the options aren't open, even if the stock isn't open. If some amazingly great news comes out on Saturday, hey, all the countries of the world decide to get together in peace and harmony and, financial trade harmony and sing kumbaya and everything's wonderful. We would expect the market to open a lot higher on Monday, right? The value would go up. And so consequently, we have to value options on days that even the markets are closed. So we base it on a 7-day week. So as each day passes, an option gets worth less. But when does that happen? Does it happen at exactly the end of the day? Like, okay, today, it's worth this, and then ding, the bell rings. Oh, it opens tomorrow and it's worth less by theta. No, it happens much more organically, much more free market. When it looks, the way market makers trade is they're always, if they have negative theta, meaning they own options, they're trading delta neutral and they're doing this thing called gamma scalping, which is a little out of the scope of what we're talking about here today. But the idea is when market makers trade delta neutral and gamma scalp, if the market goes up, they have to sell shares to get delta neutral. If the market goes down, they have to buy shares to get delta neutral. And if the stock or ETF goes up and down a little bit, they're able to scalp to lock in profits. And so stocks do fluctuate throughout the day. They go up and down, like you look at any stock chart, you'll see that there's a range through the day and it's seldom straight up or straight down. So market makers make money by gamma scalping, but they have to make enough to cover their time decay. And that's not always easy. So if the market's not really moving a lot, what the market makers will do is they'll move the day one day ahead to take the day out. And this might happen at lunchtime, right? Could happen at 2 p.m., could happen at 10 a.m. And they do that to make the options cheaper so that they're more likely to sell them. Somebody's more likely to see that cheaper offer and buy it because it's cheaper. So it'll just happen, like on days when the market's not moving that much, it'll happen earlier. On days when it's a busier day, it'll happen later. What about the weekend? On Fridays, you have to take 3 days out if you want to be trading on the next trading days, Monday. So when does that happen? Well, usually that starts to happen on Thursday. They might take 2 days out by Thursday, by the close on Thursday. They might, and by the close on Friday, they probably have all 3 days out. And sometimes it's hard to tell if you're just looking at it as a layperson. Well, is that theta coming out or is that volatility going down? So there's a little intermingling there, but I don't know. Maybe one of these weeks I'll do a workshop just on that. So there's a lot of dynamic inputs here, just like we talked about with Delta last week. As moneyness, time, and volatility change, theta changes. So Aslam said, is that manipulating the market? No, because if you look at all those bids and asks, Aslam, that is, or here, like, that is Oh, I got to go to this one. There are several market makers in the world, and the highest bid of any market maker on this option is 1027. The lowest offer of any market maker in the world is 1032. Now, I might be one of those market makers, and I might own a lot of options, and I don't want to own any more. So what I do is like, I don't want to be 1027 bid. Let somebody else buy it. I own enough. I'm afraid I'm not going to be able to gamma scalp enough to cover my theta for the day. So what I might do is I personally might lower my, actually volatility is what I lower, but we'll talk about that next week. Or no. I might take one day out to make my bid lower so I'm not 1027 bid anymore, and my offer lower so maybe I'm 1030 offer and I'm the best offer in the world. It's competitive is what it is. It's the opposite of manipulating the market. It's competitive. I want to be, if I'm dying to get out of all my long options, I want to be the first person. I want to have the lowest offer, be more aggressive, and I'll take my day out before everybody else. But what typically happens is most of the market makers are saddled with pretty similar positions a lot of the time. So if somebody sees that I went 1030 offer, they might be like, oh crap, I'm not the best offer anymore. I better take a day out too because I want to sell these also. So the market makers are competing among themselves. Absolutely. And man, it is cutthroat competition. Let me tell you that, especially these days. So yeah, good question. Thanks. That added some value to everything we're talking about here. So as far as moneyness goes, remember that's as the stock price goes up or down. When the stock gets more in or at or out of the money, theta changes. Because remember, near the money options or at the money options have the highest theta. In the monies and out of the monies have lower thetas. So naturally, theta changes as the stock moves. As time passes, theta increases for at the money options, and in the money and out of the money options stays about the same. An increase in volatility will cause the thetas of all options to get bigger. Why? Because an increase in volatility makes options worth more. The days to expiration don't change, so that means they have to decay at a faster rate to lose everything by that same date, right? Like if expiration is a week from now, 7 days, and the option's worth 70 cents, well, on average, it'll decay 10 cents a day. It doesn't actually work that way, but on average, it will. But if the options are trading at a higher volatility, they're more expensive, they're $1.40, well, then it has to decay on average 20 cents a day, right? Okay, so there's a gamma theta relationship, which I just kind of described talking about market makers. Gamma is the rate of change of an option's delta given a change in the underlying, and gamma and theta have an inverse relationship. Negative theta is the cost of a gamma benefit. Remember last week I said if you own options, you have positive gamma, and that always benefits you? It does. Even if you just own a call, you make more at an increasing rate when it's going up, you lose less at a decreasing rate when it's going down. Straddles, you have double positive gamma and you make money in either direction. But any of those long option positions that have that positive gamma benefit have negative theta. That's the trade-off. There's always some sort of a trade-off when it comes to option trading. And then short options, you have positive theta, which is great, but you have negative gamma, which hurts when the stock moves. All right, let's look at some basic examples. Here's a long call. If I buy a call, why would I buy a call? I would buy a call because I think the stock is going to go up, right? That's why you buy calls. How would I make money if the stock goes up if I buy a call? Who can be first on that one? That was a little trickier question. You kind of have to think about some stuff. This favors the more advanced people, but it also favors the people who listened to last week's workshop. Boom, Justin. Yeah, and I'm going to stick with the first part of your answer. Delta, that's just the simplest way to think about it. If I buy a call and the stock goes up, that is manifested by delta, right? I will make money on the delta. And if it goes down, I lose money on delta. That's my bet. But there's this kind of, we're running against the wind a little bit with theta. I might make money on delta if I'm right, but I will lose a little bit on theta if I'm right or wrong. Doesn't matter. I basically just want to make more on delta than I lose on theta. So I have to think about theta. As time passes, I will lose a component of my call's value due to time decay, but how much? How much? Okay, so here's what I have to look at. And I'm going to adjust this one just a little bit too. One little nuance here that can be confusing if I don't adjust it. Okay. So if I buy these 558 calls that are a little bit in the money, how am I trying to make money? Well, on delta, right? But as each day passes, well, as tomorrow passes, as we go from today till tomorrow, I'm going to lose 66 cents. Tomorrow, if the stock doesn't move at all, this is going to be worth $9.31, right? 997 minus 66, 931. So I've got to think about that. Long only option strategies require a quick move. I've got to weigh my potential expected delta gains versus my certain theta loss. And when I say a quick move, like the delta is 52 cents. If it goes up $2 today, I'll make $1.04, and that's more than my theta, so I'll make money. But if it goes $2 over the next 5 days, well, I'll make $1.04, but I'll lose 5 times 66. That's $3.30, right? So I'll lose money if the move takes too long. There's an additive quality of theta. If I buy one of those 558 calls with the 66 cent theta, I'll lose 66 cents a day. If I buy two of them, I'll lose $1.32 a day. And remember, each call represents the rights on 100 shares. So 66 cents is $66. $1.32 of option premium is $132. 10 contracts, I'd lose $660 in option theta, but what's more relevant is the money, $660. On a 100 lot, that's $6,600, et cetera, et cetera. Let's look at covered calls. Now, this is one that some people don't think about the theta on covered calls, and it's super important. This is something I talk about covered calls on my Substack, wealthbuildingwithoptions.com. As time passes, the whole reason I'm selling a call versus the stock that I own, if you're not familiar with covered calls, that's what it is. I own 100 shares and I'm short one call, usually out of the money. I sell that covered call because I should gain on the short call due to time decay. But how much? Well, let's take a look. Let's say I own 100 shares at 558.75, and I decide to sell the 562 calls, 8 days until expiration. Now, these prices are not current. This is not a recommendation, and I'm not just saying that, for fun or for legal reasons. It's literally not a recommendation. It's just an example. So I own 100 shares that are trading at 558.75. I sell the 562 calls because I think the stock will not go above 562 in this example. I'm going to make, and if it's 100 shares versus one call, I'm going to make 56 cents in option premium a day, which is $56 of money a day. So that's basically, if the stock moved 56 cents either direction, that's kind of what we're talking about. Now, this is an 8-day option. And if this stays, it's out of the money, but it's not too far away from the money in this hypothetical example. So the theta will increase a little bit as each day passes. So as long as these stay out of the money, my total theta, if you want to think about it that way, or my theta all added up, even though it changes every day, all added up over the 8-day period is 785, the price I'd sell these at now. I would make a total time decay, all my theta added up over the next 8 days, whatever it is as it changes per day, of $7.85. Which in this example, and by the way, for those of you who are watching this on YouTube at some point in the future and not live, this is a period where implied volatility is pretty high. So I'm actually selling these 8-day options fairly close to the money, by the way. This is closer to the money than a lot of my covered calls. I make like 1.1 something percent over 8 days on this covered call. And that's because implied volatility is high for those of you who are watching this live, which makes my option prices higher, which makes my theta higher. If implied volatility is lower in a more normal period, my option price would be lower and my theta would be lower. There's a lot to this stuff, isn't there? So the 8-day, 448, wait, hold on a second. That's not right. 7. 785. I don't want to be confusing here. So it's an 8-day trade, and unless I do some sort of roll or adjustment or cycle recycle, as I talk about on Wealth Building with Options Substack and podcast, it's $7.85 is my maximum benefit for selling the call, and theta rises as time passes, as long as stock stays close to the money. If I exit early, my risk may increase because my theta versus my expected gain changes. My theta gets higher, so I don't want to exit early because my theta gets higher. But I might exit early if it looks like it's going to go through the stock price. So, there's extra risk there. If there's a big move, well, first of all, if there's a big move lower, the calls get more out of the money. So my theta changes and moves closer to zero. But actually, if there's a big move upward, my theta moves closer to zero too. Wait a minute. How does that work? That can't be true. Doesn't the option get more expensive? Don't calls get more expensive as the stock goes higher, Dan? Well, they do, but that would be intrinsic value. The time value gets lower, so the theta gets lower. See, all these things are really important. If you've ever done a class on the Greeks, this is what people don't tell you. And I don't know why they don't tell you this, but this is the important stuff. Okay, theta and other option strategies. So let's talk about protective puts. All right, let's start there, and then we'll talk about other spreads and stuff like that. Okay, so here we have, we own 100 shares of this ETF, and we want to buy a put to protect ourselves. And we settle upon buying the 557 puts for whatever reason that is. Now, clearly, if we want protection for 1 week, we've got to buy an option that expires at least a week from now. Generally speaking, I typically buy options with about twice as much time as I need. Why would I do that? Why would I buy? Hey, here's a good question. Let's see who's really paying attention. Let's see who's really sharp. This is a not easy question. If I need, so I'm using 8 days in this example just because. Oh, Justin, boom. Yeah, Justin saw it coming, didn't even, have to wait until the formal question. Nice work, man. Nice work. So the formal question would have been, if I need 7 days of protection, why would I want to buy twice as much time, a 14-day put? Because it's lower theta if I go further out in time, right? Near the money options decay at a faster rate when there's less time to expiration. So if I buy more time, the theta is lower. Nice work. Yeah, and Steven, you're right there with them. Awesome. Nice work, nice work, nice work, gentlemen. Okay. So in this example, I'm just using 8 days just because it's just easier to keep everything the same. So if I buy these puts for $8.96, there are some implications here. I'm basically paying 57 cents a day for protection right now, but as time passes, the theta is going to get bigger. And when most stocks and most ETFs go down, implied volatility goes up, and so my theta gets even higher. And I have to weigh this against my delta, but this time I'm not thinking about how much I make on delta. It's how much I'd be afraid of losing as a result of delta. If I think that, spiders might go down $2 over the next week, this is a terrible hedge, because 7 days times 57 cents is what, $4 or something like that. And if it goes down $2 on my delta, I'd only make 90 cents. So I would only do this if I'm expecting a big move lower. Let's talk about spreading. So when we spread with options, we do what's called netting out the thetas. And I think we talked about that last week with deltas, right? Like, let's say I want to do a bull call spread. Okay. I want to buy the 557 calls and sell the 561 calls. So we know how that works when it comes to the prices, right? Just take 1056 minus 836, and that's $2.20 is what I pay for it. Most I can make is $3, right? 561 minus 557 minus the 220. I can make, well, actually 280, I guess, technically. But I want to know what my theta is, because, a lot of times with bull call spreads, I lose money on theta. Here I'm buying the 557 calls, selling the 551 calls. How much do I lose a day? Well, I lose 63 cents on the 557 calls, but I'm selling the 561 calls. I make 53 cents a day on these. Oh. Is there any way that I could make this a little less theta? Well, yeah. What if I buy the 554 calls and I only lose 62 cents a day? So a penny less, not a lot. But I sell the 560 calls. Okay, so 62 minus 57. Now I'm only losing 5 cents a day. I lose half as much a day if I just adjust the strike prices. What if I did the at the money? I buy the 590 calls and sell the 562 calls. Actually, there's really no theta there. I think something's a little funny here. I think I might be using a different stock price. Typically, if I'm buying the at the money, that would be the worst case scenario. But hey, you get the idea anyway. So let's talk about theta discrepancies in this regard. Time, moneyness, and volatility affect theta, right? So spreads that involve different strikes are priced relatively different from the stock price. There's different moneyness. And each one has a different volatility, which we'll talk about next week. There's different expiration months, weeks. Here, I should just say, hold on a second. I should just say different expirations. I'm looking out for you here, folks. And there's different expirations. Different expirations have different amounts of time, obviously. That's what that means. They probably have different volatilities, right? So both different strikes and expirations means there's different time and moneyness and volatility. So we can use this to pick exactly what theta we want, which is really, really powerful. We no longer have to have this thing working against us or working as much against us. Or this thing that we have working for us, we might want to really make sure is working for us. In fact, here, let's use a better example here. So right now we've got SPY at 554.29. We can look at the calls and the puts. What was that? The 19? Yeah, 19. Say you want to do a credit spread. I'm considering selling the 556. Well, yeah, consider like I think we're probably going to go down from here in this hypothetical example. So I'm considering selling the 556 calls, buying the 557 calls or 558 calls. We'll skip a strike. Okay, 556, 558. Okay, well, what does that look like? If we go with the Greeks, oh, our theta on the 556 calls is 62 cents. On the 558 calls is 61 cents. So I'm only making a penny a day today. But which one's closer to the money? 556 calls. Which one's farther from the money? 558 calls. So the 556 call theta is going to get bigger at a fast, or it's going to get bigger at a faster rate than the 558 calls. So the theta of this spread is going to get bigger as time passes. Like if you're ever trading a credit spread, you always need to look at theta on every single trade. It's the most important thing to look at. And then you might say, well, what if I do the 557, 559? Oh, well, actually, that theta is 3 cents. So maybe that's a better one to do. Right? We look at that stuff. All right. Do we have any questions before we call it a day here? Do we have any questions before we call it a day? This is good stuff, right? I like didn't hold anything back. This is the kind of stuff that I teach in our paid classes. And you get a little bit of a taste of that today. Yep, we're good. There we go. Oh, what are theta neutral strategies? Stephen, you're welcome. Yeah, well, let's talk about that for a second. Theta neutral. So if I want to do a bull call spread, usually if I trade a bull call spread, I lose money as time passes. Right? Buy the 555 calls, sell the 559 calls. I'm paying 2 cents a day. But if I still sell the 559 calls, but I go more in the money, by the 553 calls, now it's just a penny a day. It's less. So theta neutral strategies are where I adjust the strikes slightly, because it changes other things too. It changes your maximum loss potential, your maximum profit potential, change your delta, your vega. So, you need to balance all the Greeks, which is what we're going to talk about in 2 weeks. But theta neutral is just like you figure out a way to avoid paying theta by adjusting the strike so that theta is 0. Very, 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 very good question. All right, folks, have a great rest of your day. This is Dan Passarelli, Trade Smart, and I will see you next week when we talk about Vega navigating market volatility. Really super important stuff. I will see you then, folks.